Welcome to the Sustainability Podcast, with the episode The Value in Transparency Beyond Financials. Join us as we explore sustainability in the corporate world of business and how it transforms industry's social responsibilities. Hi, I am Maria.
Hi, I'm Via.
And hi, I am Dani.
Your researcher broadcasters for today,
The Voices of Sustainability.
You see, in recent years, there has been an evident escalation in sustainability reporting, acknowledged by stakeholders as a notable contributor to an organization's performance. Based on statistics, as outlined in a Securities and Exchange Commission or SEC report in 2019, 93% of the world's largest 250 companies
And 75% of the top 100 companies in 49 countries report on sustainability.
However, for the Philippines, despite this rise globally, less than 22% of publicly listed companies have only published a report on sustainability impacts and performances.
And so, as a hot topic, the organization has to respond.
The need to promote sustainability reporting to the nation served as the impetus for the Securities and Exchange Commission to release its Memorandum Order No. 4, which promotes sustainability reporting. This mandates enterprises to provide a sustainability report, may it be alongside annual financial reports or as a separate attachment.
Since its concept remains relatively new in the country, this is what moved us, the researchers for today, to conduct the study that will be our main focal point at this very moment.
To formally introduce to you, our thesis paper is entitled Effect of Sustainability Reporting on the Firm Value, the Moderating Role of Good Corporate Governance on Publicly Listed Mining and Oil Companies in the Philippines from 2019 to 2023.
So what we have here is sustainability reporting, acting as the standalone independent variable, trying to figure out its impact on firm value pertaining to the dependent variable. Take note that we also have another concept referred to as the good corporate governance, which later on, as we delve deep into the discourse, let us find out what role it provides and what motivated us to build this on with the significance of the study. The respondents have been the mining and oil industry because as one of the fields in line with natural operations, they are highly susceptible to treating sustainability as a notable objective.
To formally begin our discussion, what really is sustainability reporting?
And what really is firm value?
Per definition, on the guidelines provided by the SEC for publicly listed companies, sustainability reporting is an organization's practice of reporting publicly on its significant economic, environmental, and social impacts in accordance with globally accepted standards. Such disclosures enable organizations to measure, understand, and communicate their ESG performance and then set goals and manage change more effectively.
In the paper, it is measured through 3 dimensions found in each section of a report.
Yes, this pertain namely to number 1, the economic disclosures. This relates to how the company directly increases the pool of economic resources that flows in the local and national economy. Included in this section are the risks and opportunities due to climate change, procurement practices with respect to local suppliers, and anti-corruption. Number 2, the environmental disclosures. This relates to how the company manages the natural resources it needs for its business, as well as how it minimizes its negative impacts on the environment, including biodiversity. The company's ability to access materials needed for its operations is critical to the company's long-term success. And number 3, the social disclosures. This encompasses social topics related to how the organization manages its relationship with its stakeholders, such as employees, customers, suppliers, communities, the public, and the government. It includes disclosures on issues related to human rights, access to and quality of products and services, responsible business practices in marketing, customer privacy, and data security.
With their distinction, namely economic, environmental, and social, we hope everyone is clear about that.
Going on, firm value on the other hand, according to Mahardika 2023, is the standard price of a company that is considered feasible for potential investors in assessing its performance. It is highly important since it describes how the company's prospects are. In the study, it is proxied by Tobin's Q, more commonly known as the Q ratio, calculated as the market value of the outstanding shares divided by the replacement value of the firm's total tangible assets. Generally, the purpose of companies that have gone public is to increase the wealth of their owners by increasing their company's value. While financial reporting stands crucial to assess the state of an organization, reports on green initiatives essentially surface as a necessity in this ever-changing day and age. So by utilizing a quantitative approach, we aim to enrich our understanding of the implications of sustainability efforts on the worth of the organizations, especially when mediated by how management is directed and controlled.
So, what did the statistics conclude?
Well, on average, the firm value of the companies in terms of Tobin's Q is 1.1097. Since the metric is higher than 1, it conveys that the majority of the companies have greater valuation with a favorable potential market for growth. As supported by the literature of Hayes 2021, this implies that stocks are overvalued and organizations are earning a higher rate than their replacement cost, prompting individuals or other entities to establish similar businesses to capture some of the profits.
And what about the sustainability reports?
Through the statistical treatment of data, the results revealed the following: 44.34% for economic, 55.23% for environmental, and 38.64% for social. The rates can all be interpreted as close to half, signified by how sustainability reporting is still in its initial stages. And unfortunately, out of the 3 indicators, all of them contain positive but insignificant effects on firm value.
I think that inevitably, a possible reason for all the dimensions of sustainability reporting have no significant effect on firm value is because of the less prioritization of sustainability practices. Fluctuations in the prices of commodities like oil, gas, metals, and minerals significantly affect mining and oil companies. They are also more inherent in social and environmental risks and may put their initial focus on earning profit. This led to giving greater attention to solving these issues and generating strategies to achieve their main objective. As a result, it overshadows the attainment of sustainability development goals.
Now let's talk about good corporate governance, or I must say the GCG, and its connection with sustainability reporting and firm value.
Take this as an example, since the mining and oil companies are the respondents in our study and we know they often harm our environment and the community living nearby where they are working, sustainability reporting is created to show their care for our planet and the community. This is also the reason that drives the lawmakers to mandate the implementation of this. But how can we be sure that these sustainability reports are reliable and credible enough to be a basis of firms' work? And that's where good corporate governance will come in.
What exactly is GCG anyway, so our listeners can understand it? Is it like a guide for the companies to know they are doing the right thing?
Exactly, because according to the Corporate Governance Institute, good corporate governance is the effective running of an organization through the strategic implementation of policies and practices which lead companies to success. So this means that this is a set of rules and guidelines that a company needs to follow to be aligned with their set objectives. And there are people running behind this.
And who are they?
Just like how our country needs a good president to perform well and keep pace with other countries, a company needs people or well-composed board of directors to achieve good corporate governance. As they maintain to be transparent, accountable, responsible, independent, and fair, they ensure that sustainability reports are accurate and reliable. If investors know they truly care for the environment and society, they are more likely to invest in the company. So this affects the value of the firm since the investment helps the company to grow.
I think our listeners can connect the dots now on the role of good corporate governance with sustainability reporting and firm value.
Yes, that's good. But to dive deeper, our study used 3 metrics to provide insights into how committed mining and oil companies are to their corporate governance. These are the number of members of the Board of Commissioners, the proportion of independent commissioners, and the number of audit committee meetings in a year.
Via, you mentioned both the Board of Commissioners and the Board of Directors. Can you elaborate more the difference between the two?
Yes, so before I discuss further, you may notice later that I will interchangeably use the terms commissioner and director. This is because in the Philippines, all corporations are structured in a single board system that has one board of directors. It is composed of executive and non-executive directors who handle the management and supervision of the business. Unlike the other corporate system, the dual board system, it has 2 boards, the Board of Commissioners and the Board of Directors. The first type of board supervises while the Board of Directors manages the organization. The directors in the adopted corporate system in our country have a similar function to the Board of Commissioners in a 2-tier system. So there is no difference between the two, especially when you adopt the single board system. Going back, to make sure that the companies are running well and ethically, the Philippine SEC Code of Corporate Governance states that the company should be headed by a competent working board to foster long-term success and sustain competitiveness and profitability consistent with the objectives and interests of stakeholders. What I mean in competent and working board is the Board of Commissioners or Board of Directors.
Is there any ideal number of members to have on a company's board?
Yes, the SEC recommended that the board be composed of at least 5, but no more than 15 members with the right combination of executive and non-executive directors and independent directors. This is implemented to avoid the domination in the decision-making process.
Does the number of members of the Board of Commissioners really matter? Can having more or fewer directors actually affect the performance of a company and how it reports its green initiatives?
Yes, it matters, and it turns out that having a high number and diverse directors on the company's board is a good thing. Research has shown that a large number of directors who have different backgrounds affect the effectiveness of monitoring and controlling agency problems within management. Their various skills mitigate the risk of mismanagement, positively affecting the firm value. Because of this improved effectiveness of monitoring, management is also encouraged to submit reports such as sustainability reports. As a result, this can satisfy the regulators as it is mandated by the law and the stakeholders' interests at the same time.
So how about the proportion of independent commissioners? Can you enlighten us first on who are they and then their role in our study?
The independent commissioners are also part of the Board of Commissioners who are not materially related to the company they serve to maintain independence following the principles of good corporate governance. Since they are not directly involved with the company's daily operation, it would result in more objective advice and supervision. This shows that it is a way to strengthen corporate governance to enhance the quality of reporting and the focus on sustainability, which affects firm value.
How is it possible?
In the studies of Ivana and Jafar and his co-authors, they infer that the high proportion of independent commissioners may result in stronger monitoring of corporate performance without any influence from inside the company. This enables them to make decisions more effectively about management practices and equally satisfy shareholder rights. As a mediator also in agency problems, as an example, it lessens the effect of family control on corporate performance.
Is there also any regulation on how many independent commissioners must be on the company's board?
Yes, the SEC Corporate Governance Report expressed that the number of independent directors on the board must be at least 2 or at least 1/3 of the members of the board, whichever is higher. Yet most of them are non-compliant with this.
Oh, but is there any other reason why our study resulted in a general upward trend of independent commissioners from 2019 to 2023?
It may be because of their characteristics and the demand to mediate the conflicts between the principal interests and those of the organization, like what I have said earlier, as they also act as a mediator in agency problems.
Since we specifically talk about the proportion of independent commissioners, is there also a specific way to calculate the proportion of independent directors on a board? Like, is there a formula to figure this out?
Yes, it can be calculated by dividing the number of independent commissioners by the total number of all the commissioners in an organization. And since we have talked about the importance of independent directors, let's proceed to another key aspect of corporate governance, the number of audit committee meetings in a year. Do you have any idea how many audit committee meetings should a company conduct in a year?
4, 6.
To our listeners, do you have any idea? Let's see. But before that, in case you didn't know, that audit committee is also one of the important members of corporate governance. They are responsible for overseeing an organization's financial reporting, risk management, and other internal controls. According to the general instructions for the preparation of the Integrated Corporate Governance Report for the publicly listed companies published by the SEC, the audit committee should hold regular meetings at least 4 times a year. So you're both correct.
Yes, but how does this contribute to our study?
The recurring holding of meetings following the standard enhances the organization's disclosure practices, internal control, and audit from planning to report issuance. Overall, this is performed to influence the overall economic worth of a firm's asset and the possibility of generating economic return to investors.
Is there a research that supports this idea?
Some previous research affirmed that the audit committee meetings monitoring effectiveness will improve as they meet more often. SEC added that the matters discussed should be communicated with the external audit team without anyone from management present to gain better views and suggestions for the company's performance. So, this encourages management to provide financial and non-financial information to the company stakeholders to avoid conflict of interest between management and shareholders. The frequent meetings directly affect the company's disclosure practices such as sustainability reporting. So, when this is considered by the investors as a value-added information, this will be the basis of their decision affecting firm value. Now that we have discussed how good corporate governance interplays with firm value and sustainability reporting, we are ready to explore the results of our study in this specific aspect. GCG moderates the negative effect of sustainability reporting on firm value. It showed that effective governance mechanisms improve the transparency of sustainability disclosures, as organizations with sound corporate regulations tend to provide more thorough descriptions of their sustainability indicators. According to a previous study, corporate governance influences sustainability reporting by ensuring that boards of directors prioritize environmental and social concerns, aligning corporate strategies with sustainable development goals.
Well, it was good to know the powerful role of good corporate governance. It was clear that it can make a difference in a company's success.
Yes, and how about you, Dani? We use different control variables in our study. Can you explain what those are and why we include them?
Right! Even though control variables remain constant, they may still affect the study's outcome, so it's important to consider this. We use cash value relative to total assets, firm size, and sales growth.
Cash value relative to total assets? That might be new to some. Do you mind to explain it?
Yes, it's basically a cash to assets ratio computed by adding the cash and cash equivalents and dividing the sum by the company's total assets. Through this ratio, the management and investors can determine whether the company has adequate cash reserves.
But how can you tell if a company has too much or too little cash?
Well, it depends on the industry and the size of the company. Normally, they maintain sufficient cash reserves to cover 3 to 6 months of operational expenses. This is to make sure that the company is liquid enough to pay for debts while seizing the opportunity to make investments.
So, how's the cash to assets ratio of the mining and oil companies for the past 5 years?
Oh, it peaked in 2021 and then decreased in 2023. The increase may be from the reopening of the economy after COVID-19. Konoza also stated that there are new mining ventures that have the potential to provide job opportunities, tax revenue, and exports, all of which can help grow the nation's economy.
Then why does the ratio drop in 2023 if there are new mining ventures as the lowest ratio recorded in 2023?
They might have invested it in new projects instead of keeping it idle. Also, the lowest average of this ratio was recorded in 2019. Patel mentioned that having a low cash to assets ratio may be because of a higher rate of unrealized revenue, maintaining excessive inventory, and poor cash management.
So it's all about effective cash management. Then how about the firm size?
The size of the company matters as it affects the investor's prospect of a dividend from the firm. There are various ways to measure it, but for this study, we use the natural logarithm of the company's total assets since it is the most stable value.
Are the mining and oil companies included in our sample considered large companies?
Based on the findings, the firm size displayed a rising trend for 5 years. The average shows that the companies are large and moderately high compared to the average value of another previous study. You know, being a large company comes with lots of benefits. That size suggests favorable growth, which draws investors and increases the company's value.
Was firm size affected by the COVID-19?
Of course, the lowest mean of the firm size was in 2019, though it's not relatively low. The adverse effect of the COVID-19 pandemic on the worldwide mining industry became apparent promptly and severely, with mines, ports, trains, and other transportation networks locked down and shipments trapped at sea. This in turn affected the company's development and growth.
Then this might have also affected the company's sales growth, right?
Definitely. However, the results of our analysis showed that there was a steady increase in sales growth from 2019 to 2021, which displays the company's resilience and how it coped during the period of pandemic. The proceeds from the production of oil and gas skyrocketed in 2021 as energy prices recovered from a steep drop in the initial phases of the COVID-19 pandemic. Yet, companies weren't able to surpass their sales from 2021 and 2022, which resulted in a sudden drop of sales growth during 2022 and 2023.
How did all these variables affect the sustainability reporting and firm value?
Well, contrary to our expectation, the findings show that the control variables have a significant but negative effect on the firm value. Previous studies support these results, which state that high levels of cash reserves have a negative impact on a company's investment efficiency, especially when there is an economic crisis like the COVID-19 pandemic. Also, a larger size denotes positive growth, leading to a high probability of obtaining the investor's interest and boosting the firm's worth. Lastly, sales growth is a determinant of firm value as the achievement of the company's objectives is based on this progress.
Does good corporate governance also affect the relationship between the control variables and firm value?
Yes, for instance, previous studies showed that a higher complexity of operations requires a larger corporate board structure to provide more input to managers and access to information and resources needed by the company. The greater the company's size exhibits the firm's growth and becomes an opportunity for companies to increase profitability and indirectly increase the company's value.
We therefore conclude that based on the data we gathered, the market perceives future growth prospects for mining and oil companies regarding their overall firm value measured by Tobin's Q. Among the indicators of sustainability reporting, we observe that there is a significant area of concern with social disclosures as they fluctuated over the years, mainly due to the nature of the companies themselves. Even though there were general trends of improvement in economic and environmental disclosures, none of the indicators of sustainability reporting, economic, environmental, or social, has a significant effect on firm value.
The frequent structure of the Board of Commissioners and the number of audit committee meetings in a year of the listed mining and oil companies also generally adhere to regulatory requirements, while the proportion of independent commissioners indicates a preponderance non-compliance with SEC regulation over the past 5 years. But maybe due to their characteristics, there were a general upward trend result. As a mediator, GCG weakens the negative effect of sustainability reporting on firm value and the negative effect of control variables on firm value.
Cash value relative to total assets and sales growth of the listed mining and oil companies had increased from 2019 to 2021, but subsequently declined, which is attributable to the stabilized management of liquid and physical assets and investment, resilience during the pandemic, and volatility of commodity prices and their sizes were generally increasing with its peak in 2023 that signifies an effective and efficient operation through developing market conditions. This follows that the control variables negatively affect the firm value and insignificantly affect sustainability reporting.
Thank you for tuning in on this episode where we dive into the significance of sustainability reporting.
We hope that today's discussion passed on valuable insights into how transparent and impactful reporting can be a catalyst for making a change.
Until next time, keep driving for progress and continue being accountable for a blissful society.
I am Maria.
I'm Via.
And I am Dani.
And this has been
The Sustainability Podcast. See you!